So again, in this video, we're going to look at alternative exits. So these are just, again, some options that we can use to really fine tune these strategies and find the most profitable and best way to trade them over many trades. Over the years, I've continually compared the results of actively managing trades. That's where, while we're in the trade, we're deciding, okay, am I going to get into this? Am I going to get out of this? Am I going to stay into my target? Am I going to expand my target? And I've compared it to just using a fixed reward to risk, and the results almost always indicate, unless you're looking at a very short period of time, but over many trades, they almost always indicate to just leave the trades alone. And there are a few exceptions, which we're going to talk about in these videos. So for the most part, just leave your trades alone unless there is a reason to exit, like the ones that we're going to discuss in this video. And we've already talked about a couple of them throughout the course, so you do know a couple of these already, but we're just going to go over them again. So, and we've talked about this in the strategy too. Just leave the trades alone unless we have one of the situations we're going to talk about. So we'll get to those in just a minute. When we exit trades early because we think, ooh, the price is getting close to my target, but it's starting to pull back, I'm just going to get out, we end up over trading and abandoning the very thing which makes these strategies successful. And the thing that makes them successful is that they've been attuned or based around a 2.5 to 1 reward to risk. We've found small stop loss entry points that allow us to make 2.5 to 1 in a very short amount of time. That is our edge. That is what gives these strategies a chance at success. If you start exiting trades early, your win rate may go up slightly, and that's what most people are going for. They don't want to lose, so they cut their winners early as soon as they start to pull back. But if you try to go for more wins, typically your reward to risk is going to fall dramatically. So let's say you stick to the 2.51 reward to risk and you have a 50% win rate. Over 10 trades, you're going to make 7.5% on your account. But let's say you do not hold, so the price is maybe getting close, but then it starts to pull back and you exit your trades. That's going to likely give you more of a 1.5 to 1.75 reward to risk if you wait till it at least gets close but then is pulling back, because it didn't even get there to begin with and now it's already starting to drop, so you've waited for it to drop and now you're getting out. So it's going to cut your reward to risk possibly up to half. And so your win rate may go up because some of those trades that you got out of may have ended up hitting your stop loss. So let's say your win rate goes up to 60%, but your average reward to risk on those trades is 1.75 to 1. Your overall profit actually drops by a fair amount. You've lost 1% out of your 7.5. So that's, of the profit you made, you've lost more than 10% of it by exiting early. So you've dropped to 6.5% profit over 10 trades as opposed to 7.5%. That's a pretty big margin. You think over 10 trades, that might be 2 days worth. So you multiply that by 10, because we have about 20 trading days in a month, and you're talking about 20% in a month. The markets almost always give the opportunity to cut trades early. The markets are nasty like that. They do not very often just explode to our profit target in one price bar. It may explode at first, but then it has a little pullback and it scares you. Or it, is just kind of doing this all the way up to your profit target. It's just choppy. There are nearly infinite opportunities when we look at all our trades to get out early, because even if we're pretty convinced the price is going to hit our target, there's always going to be little things that the price does that tries to scare us out of our position. And it's usually going to give us the opportunity to get out at a worse point. It's dropping, so we're scared, so we get out, and then immediately it turns around and goes. And that's, a lot of people think the market's out to get them, and that's just how the market moves. That's why the market moves that way, is because people get scared, punch out, then all the people who were scared are no longer in the position. So the price is going, let's say the price is going up, and there's a little bit of selling. Anyone who's scared, of course, sells as well. So there's a bunch of selling that hits the market, dropping the price. Now all those people who were scared have sold out, so there's no sellers left at that moment. And then the price goes back up, making those who just sold feel dumb and that the market was out to get them. But it was actually their own actions that created the drop in the first place. And a lot of people don't understand this, that there's other people who have similar types of, problems or personalities that are, prone to getting scared, and so they all sell at once, causing that little pullback, and then the price moves right back in their direction. And, if they hadn't panicked, then the price would have kept going out, as a group. So that's why it often feels like the market's out to get you, but it's just you acting in unison with other people who kind of have the same tendencies to create those little situations where it feels like you're always getting out at the worst possible point. And we can avoid that by simply sticking to our strategy. If you're going to exit early, it must be pre-planned before the trade. And that means it also must be in our trading plan. These are the only reasons there is to exit early. So there's a couple here, and then we'll talk about one in a little bit later on after we go through a couple of these examples. So really 3 reasons to get out of trades early. The main reason is news is coming out. So we've talked a little bit about news before. I told you how to look up the economic calendar. So you're going to check your economic calendar, see what news is coming out. You're going to write it down on your chart, and you're going to get out at least a minute, but preferably about 2 minutes before that news is coming out. And that's just in case, who knows, someone's watch is wrong and the thing gets released a minute early or something. So we want to be out of that at least a minute, preferably 2 minutes before that news announcement coming out. And we're not going to enter a new trade a couple minutes before the news announcement because we have to get out of it right away. So that's not... You've cut your reward to risk, because there's no way in 1 minute that the price is more than likely going to hit your target. So that means you're taking a trade that is either going to have a small loss or a small profit, and it's going to help throw off that overall reward to risk. We want to make 2.5 to 1 on our trades. If we can't do it, we don't want to be in it. If we only have 3 minutes till news, we know that we have to get out in a minute, we do not want to take that trade. The other main reason to exit a trade early is what we talked about in the prior video. We get a valid signal in the opposite direction. So we have the rounded top, it transitions into a rounded bottom. We have those options that we discussed in the prior video. We can exit that rounded bottom trade, exit the rounded top as the rounded bottom triggers into the trade, and then we have the option, do we want to take the trade in the new direction, or is something else telling us we should maybe wait for a different opportunity? So you can go back to that video. That covered it a lot more and all the options. So I've just kind of put the main points here again. You can read through those if you like. Here's just an example of, even when I try to outsmart my strategies, I typically end up worse off most of the time. So here's an example where here I got out early, and the price may have hit my target there. It looks pretty close, but I didn't touch target, so maybe it was like 0.1 pips away. So this one, would have been a potential loss. So I ended up making 3R, and I would have been down 1R. If I had not got out of this trade, because eventually it would have hit my stop loss down here. Now, here is another one, and I got out of this one early. So I made 1.2R. You can see it almost got to my target and then pulled away. And it kind of, I was like, do I want to potentially lose on this one? I'm like, no, it's either going to break higher or it's going to drop. So I kind of messed up my rules there. and decided to get out early. And I moved my stop loss up to here. So the price did drop and almost came back to the entry point, but then it went back up and would have hit my target. So I would have made an extra 1.3 pips there. And this one would have ended up being a 1-point loser. So, it was no benefit to me to get out early. Because I would have made more on this one, and I would have ended up losing a little bit on this one, but overall, there was no benefit to getting out of the trades early. So this is just one example, but over many trades I find the same thing, is that yes, on one trade you may think, oh, thank God I got out of that trade. I would have ended up losing, and instead I made 0.3R, high five, I'm such a good trader. But then on the next trade, you get out for 1R profit, and you would have made your 2.5R. So you're actually down. You could have been up quite a bit more had you just stuck to your profit targets. But we tend to chicken out, and so there are situations where sometimes we're coming up to the end of the day. So if you do not have the option to stay, you got to go to work or something and you're trading, then you may opt to get out, a little bit early. Like if the price is getting close to your target and you don't want to hold it through the reversal, then, we need to adhere to our life. The other option is you just leave that trade out there, right? My target was out here. Again, I got a little bit antsy. I knew I was coming up to about 8:30, which is when I usually quit. So I just decided, okay, I'm going to cut this one off. If I would have just left my order out there, it's going to hit that stop loss or target eventually, right? We have lots of time left in the market still going before the U.S. close, many hours. So I could have just left this one out there, and instead of making 1R, I could have made an extra 1.5R because it would have hit my target down here at 2.5. So I would have made an extra 1.5R there, plus an extra 1.3R there, so 2.8R, and my net difference on this one would have been, I would have lost 1.3R, right? Because I made 0.3R, but I actually should have lost 1R. So that's a 1.3R swing to the negative, which is basically offset by this one, and by just sticking to my targets, I would have been up an extra 1.5R. And again, that's kind of just goes back to that reward to risk. It's not a huge difference, but when we're talking about these kind of mistakes happening once every day or 2 days or 3 days, you're talking about 1 to 2% every couple days. That's 20% over the course of a month. So like tiny errors just add up over the course of the month, and that can be the difference between being a profitable trader and a losing trader. Is this exact what I was doing on this day. Getting out of trades a little bit too early, not holding to the target. So I ended up being profitable this day because we had some other opportunities. But if, this trade hadn't been there or something like that, I could have easily been negative on this day just by these little errors. And over the course of the month, if you're up, 20, 30R, or a potential to be up 20, 30R, and you have, one mistake like this every couple days, that could be 1 or 2R. That erases your entire month. You're actually a negative trader despite taking all the correct trades, but by just not holding to the target and realizing that reward to risk, you're actually a negative trader. So it's very powerful to go back through your charts, like we've talked about, doing the review process, how to actually practice and review, and see what your profit would have been had you just stuck to the plan of the trades. And for most of you, like 99% of you, you are far better off just letting the price hit your target, including myself. And I've been doing this for 16 years, and when I try to outsmart it, I still end up worse off than I would have been if I had just stuck to my target. Over many trades again. This was a good day to show how it worked out. I would have been better off by 1.5R, but the same thing works over many trades. And what were we looking at here? This one, oh, this was just an example of where we can move the stop loss once we do have a valid pattern. So this one I did get out early, but this was for a valid reason because we actually had another pattern that occurred. So we have the rounded top. We start to see this shift to the downside. I'm selling, or here's the shift, pop up, shift to the downside. I mean, we get so close to my target. And what is this? A double pump. Move up. We had the drop, the move up, the drop, the move up. Very symmetrical. And we have the shift right there. So this was our double pump, gets near the high, shift back to the downside. We could have taken this as a short. So this was a valid double pump pattern. We're right near the end of trading, so I opted to use that pattern as my stop loss, lock in some profit, and that's totally valid. We can use other patterns to reduce our stop loss on prior trades. This one was also an option we could have added to this position, which means I would have made 1.23R on the original rounded top trade, but I would have ended up losing 1R on the double pump had I opted to take it. This one happened to be close to the end of my session, so I did not. And also, we hadn't really made a lot of progress below this swing low. So it wasn't, even though this was a nice little drop here, overall, we weren't really seeing huge selling pressure anymore. So this would have been a fine trade to take if you had been trading a little bit longer, but for me, I didn't think it was going to sell off quickly enough coming up to the end of my session when I like to quit. So either way, stop loss got dropped on that one. There will be days, we talked a little bit about this already, there will be trades and even days, maybe even a week, where the results would have been better if exiting early. And all I'm saying is that over the course of a month, over many trades, when you add it all up, nearly all people are better off just leaving their trades alone, except for the reasons I've mentioned so far, and we got one more to go over. Because it's monthly profit we're concerned about. People who get too wrapped up in being profitable every day are typically going to end up underperforming what they could have done if they kept a little bit bigger picture in mind and were focused on their monthly profit. What's best for my monthly profit? Go through a whole month of charts and add up how you would have done over the month if you traded correctly versus just trying to get into trades and make a quick profit just that you can call the day profitable. That's typically not going to work out very well because you're never going to have those really big winning days which make your monthly profit so big. And these strategies can provide really big monthly profits, but we need to be around. We need to be in those trades when the price hits our profit targets, sometimes multiple times in a day. Go through your charts and see that typically especially after you have more than a month, 2 months, 3 months, 4 months, just go through your charts and add this up for yourself. See for yourself what the difference is between holding your trades and getting out of them earlier, or what you did. See the difference. So we're going to talk about that a little later on. It's called efficiency. What's the difference between what the strategy produced if you had just followed it versus what you produced? And ideally, we're trying to get our efficiency up so that we're getting close to what the strategy actually produces. And most people, you'll find, are very far away. They're underperforming their strategy they're making half or less of what the strategy produces just because they continually make tiny mistakes. And one of the big ones is not holding to the profit target, except for the reasons mentioned. And this one. Finally, in low movement environments where we can see the price isn't moving enough to typically reach our 2.5 target, we do have the option to use a target of say 2 to 1. I don't really go below 2.1. There's no point. I don't want to destroy my reward to risk over the course of a month. But on one day, if it's pretty low movement and I see that the price is been moving enough to give me 2 to 1 on most trades, but it's like really sketchy or it hasn't been hitting 2.5 to 1 targets if I look back, kind of I trade during the US session. So if I look like a little bit the last hour or two of the London session, maybe there was an opportunity, but the price isn't really moving much. We have that option to reduce our target. But we want to do this sparingly, because if the price is going to struggle to hit a 2-to-1 target, then we don't really want to be taking that trade, and we don't want to keep reducing it where we're to that point where we're just bouncing in and out of trades trying to make a 1-to-1 reward to risk. That really destroys the strategies. They're not meant for that. They haven't been tested for that. I've never traded them like that. So if you go down that road, you are potentially going down a unprofitable path. What I have found, though, is that if I'm willing to trade for 2-to-1, that's where I put my target. It usually ends up hitting 2.5 anyway. It's my own fear that caused me to change it to 2-to-1, not necessarily the market. So here's an example of this. This one, we're under 15 pips of movement in the last 3 hours. Just under, looks like, because from here to here, probably like 14.9 pips. So we're on that cusp. We're in that gray area. We can trade a little bit, but we want to be a bit on the cautious side. As I mentioned, I don't like taking trades like in the middle of low range areas unless the target can be well inside the range. But what I will look for are the rounded bottoms near the bottom of choppy price action, or rounded tops near the top. So this was one, but I was just looking at this and thinking, it's pretty choppy. I'm just going to go for a 2-to-1. And that was a little bit maybe scared on my part, because this would have actually hit 2.5 to 1 on a little stop loss. This looks like probably about a 2-pip stop loss. So the extra 0.5 is only like half a pip extra, or a pip extra. So I would have ended up getting out of this by 0.1, 0.2, 0.3 pips. So it was pretty close, but it actually would have hit my 2.5 to 1 target. But so I have found that over many trades, they're typically going to hit the 2.5 to anyway. But the point is that you want to pre-plan what you're going to do. And I said I was going to use a 2-to-1 here because it was a little bit choppy, and I stuck to that. So I did end up making 2R, and that was the only trade that day. So, hey, that's a good day. 2% on the account with risking 1%. Solid. If you could do that every day, that's a good month. So stick to the plan, pre-plan your exit if you're going to exit early. Nearly all trades use a 2.5 to 1 reward to risk unless there is low movement and we opt to drop it to whatever number. So the 2.25 or 2-to-1. We also have the option to increase our target. So we're always using the 2.5 to 1, but there may be a situation where it's actually better to increase it. So sometimes we may opt to decrease it to 2-to-1. Other times we may up it to 3-to-1 or 4-to-1. And I find the best time to expand targets is when we're seeing big price swings, but we get an entry opportunity with a small stop loss. So let's say the price is, it's running like 10 pips up, pulling back a little bit, forming tight little price bars that give us our entry points. So we're getting like 2-pip stop losses, but the price has been running like 10 pips after those entries. We could easily bump our target up to 6, 7, maybe even 8 pips for our 2-pip stop loss, because we've been seeing the price has been running quite a bit. And so we have the opportunity to get out of a trade fairly quickly in these 10, maybe even more price movements. And if we just use 2-to-1, 2.5 to 1, we have a 2-pip stop loss and a 5-pip target. That's great. A 2.5 reward to risk is a solid return. But we're only taking advantage of, about half of what the price is running. The price has been running way past, maybe we've already seen it, the price has run way past our targets already a few times, and it's showing no signs of slowing down. It's just, continuing to run. It's a really strong day, or a really sell-off day, strong trend going on. So why not try to pick up 6 pips, 7 pips of that move? And by doing so, we're actually bumping up our reward to risk. So if we bump our target up to 6 pips, we've moved up to a 3-to-1 reward to risk. We bump it up to 7 pips. We're up to a 3.5-to-1 instead of 5 pips, which is our 2.5-to-1. If we bumped it up to 8 pips, we're at a 4-to-1 reward to risk. And when we add up, if you kind of average out your reward to risk at the end of the week or the end of the month, even one of these trades can really help, skew and add a little bit of extra profit, because a 4-to-1 reward to risk, we're making an extra 1.5R, which covers another loss and a half. So, it can really, one of those a month can really start swinging you out of negative territory, or could, if you're already profitable, just help really enhance, giving you that extra, 1, 2, 3, 4, 5% a month, depending on how many times you end up doing this. I do this sparingly. It's not a common thing. If you look at my charts, it doesn't happen very often. Occasionally you'll see like 2.7R, 2.8R, 2.6R. That's not necessarily because I expanded my target. That could be just my position sizing was a little bit off or a little bit too big. And the ones that are quite a bit different, the 3Rs, the 4Rs, the 5Rs, that's usually because I expanded my target a little bit, and I put a note on my chart when I do that. So it doesn't happen very often, maybe once a week, but even then, maybe once every 2 weeks. So it's not something I do very often. It is something I probably could do more of, though, if you went through your charts and really looked at what kind of situations you could expand your targets in. Once the price has run past your 2.5R target, so maybe you had your 2.5R target and it's running towards your 4R target, your 4-to-1 target, I'd recommend protecting that 2.5R. So you can do that with a aggressive stop loss. So I'll look at that on the next chart. And, if the price keeps running, just maybe move your stop loss below the low of each price bar. If you're going long and it's moving up towards your 4R target, just move your stop loss up below the low of each price bar once you're past that 2.5R, just to help lock in that profit. That way, you're going to get at least 2.5R, or it might be a tiny bit less if you had to move up your stop loss as the price was moving through that area. But you're still giving yourself the chance to make that 3 or 4R price target, but you're also protecting the 2.5R that is standard for most of our trades. Because it does kind of suck when you go for a 4R trade and then it quickly reverses on you and you end up losing 1R because it hits your stop loss when you could have easily had and made 2.5R. Those ones are pretty frustrating when you're going for a little more and you end up with less than you could have had. So here's an example where I did opt to go a little extra. And in this case, I decided, and I have this written down in my plan that I'm allowed to do this. So it's pre-planned in a way. So my target originally was 2.5-to-1, and it was sitting like right here. And the price got really close to it and then pulled all the way back. And when we're in a trend, what do trends do? Uptrends tend to make higher highs and higher lows. So I figured the price is, if it comes back up here, it's not likely going to just stop right there. The price is moving up, so we're probably going to make a bit of a higher swing high. So I just pushed my target up. I also had this area over here where I thought if it clears this high and gets close to this high, there's probably some stop losses sitting up in this area from people who have been short kind of all morning. Or this was during the London session, so people have been short from the London session into the US session. And this would be, if you're a little bit longer term trader, looking at, the last hour, couple hours, this would probably be the place you'd have your stop loss. So I just looked at that level and I thought, I'm going to use it because the price is probably going to get there. It might spike up a little bit. So I even could have put it just a tiny bit above, capture a little bit more. But 3.3-to-1 reward to risk, hey, that's pretty good. So I used this prior level, which the price hadn't hit, and just assumed it's either going to hit my stop loss or if we keep trending up, I may as well make a little bit more because the price is likely going to clear above this high. What you could also do to look for an estimate is from here to here, we can see the price moving up from this high to this high, probably about 5 pips or so. So we could, or maybe a little bit more, 6 pips. So what we could do is shave a little bit off that and just add it to this. And that's also what I kind of did here, is I added about 3 pips to, assuming that the price would run probably at least 3 pips above this prior high, because the last time it ran about 6 pips. So I just shaved a little bit off and assumed that the price would run up above this high. This is a similar situation where I had my original target right here at 2.5 to 1, pretty much where this little dotted line is. And the price dropped to it and kind of consolidated there. And again, I figured, wow, the price, we're having a pretty strong sell-off here. If it drops, it's probably not just going to drop a little bit. It's going to, keep running. So I kind of looked at, how far was this drop? Okay, it's about 5 pips. Then we consolidated. So we may drop another 5 pips or so after it. And yeah, ended up getting 4 to 1 on that one. So just a couple examples of how you can sort of pre-plan your increases. So these were examples where I did have a 2.5 to 1, but my plan does allow me to increase it, assuming we're moving in the trend direction and the price is going to exceed my target anyway, because we're holding through the pullback or the price is going to break out of a consolidation. And what you'd want to do in this type of situation as well is, so once we get that breakout, once the price is moving beyond our 2.5 target, which is this little blue line, then I'd advise locking in a bit of profit. So once it breaks out, move your stop loss to right there. Then the next bar closes, move your stop loss to just below it. Once this bar closes, move your stop loss below it. If it hadn't hit your target yet. In this case, it hit my target right there. But let's say I had my target like down here. My stop loss would have moved just below this little, or just above this little green bar, and then this bar would have taken up my target. Or if it hadn't, I would have been stopped out right here. Still bigger than a 2.5, but wouldn't have quite hit my, let's say, 5 to 1 reward to risk down here. Option to do that on this trade as well. So we know that my target was sitting just above here to begin with, and then I expanded it a little bit. In this case, we just had this big kind of explosion, so we didn't really have a chance to move our stop loss up. But let's say the price hadn't hit our target, we could have put our stop loss just below this bar. It's going to be pretty close to that 2.5R, so we're locking it in, but we're still giving the price the chance to hit our target, let's say if it was up here and hadn't been hit yet. And so that, again, we're just finding that balance between still protecting our 2.5R. As we talked about, these strategies are really based on having a solid reward to risk, so we want to protect that, but we also want to give ourselves the chance to get a bigger target when we can. So these are situations where we could do that. So the reasons we exit early: news, a trade in the opposite direction, or low movement and we've pre-planned to have a smaller target. And then we can also pre-plan a target increase, and that could be just at the outset of our trade saying, ooh, this is a really small stop loss, we're seeing big movement, I'm going to go to 3 to 1, 4 to 1. Or this type of situation where the price almost hits our target, and so we know that if it moves past it, it's probably going to move a little bit past it, and we decide to up it a little bit that way. Those are really the only times that I will adjust my stop losses and targets. In the next video, we're going to talk a little bit more about what we talked about in this video, the importance of our reward to risk, and we'll also look at some scenarios for the win rate, which we also did in this video, so we'll look a little bit more into that.